Welcome to The Real Money Show, the number 18778 Silver, the website guildhallwealth.com. My name is Jeremy Wiseman. I'm Vice President of Guildhall. I'm joined by Jerry Correa, Senior Broker here at Guildhall. And Jerry, we've got a lot to talk about today. We've got, we're going to take a little trip over to Europe, talk about what's happening there with their rate hikes. We'll talk about the Fed's balance sheet and what that can mean for the economy, what it can mean for gold and silver prices down the road. Then we also want to mention Rafi Farber. He's a great analyst in the market. We recommend everyone follow his blogs. He puts a podcast out through Arcadia Economics. We'll talk about that because he has some good information about the COMEX inventories. So anyone who's interested in precious metals and what's coming up for precious metals, or who may be despairing about the precious metals right now, we'll be very excited when we talk about the COMEX inventories. Also, we'll talk about the Woke Bank of Canada. An article came out through Epoch Times that was really interesting because it seems, Jerry, that they're looking for scapegoats as to why the economy is so fragile. So we'll get into that. But first, let's talk about the wild price action that happened this morning. We're taping the show on Friday, and you were just mentioning before we went on air that the prices for gold and silver were quite erratic the first half of the day.
Yes, it was. So followed by the retail sales data that came out earlier in the week, which sort of put metals, had to give us some headwind, push metals down a bit more. CPI inflation of the States was scheduled to come out at 8:30, came out higher than anticipated, which signals that the U.S. Federal Reserve will need to keep the pedal to the metal and continue its rate hikes through the summer months, but likely will be pausing August, maybe September, likely in September, a huge pause. But what that does on the algorithm side of trading, remember everything is just digital, no one's selling any metals back. It pushes the algorithm, the sell button on the precious metals. That happened immediately. So as the print came out hot, 8.6%, everything's going on up in flames there in the U.S. And mind you, that's just the CPI data.
Can we just reminisce on when inflation was transitory?
Transitory.
Can we just reminisce on that?
That was a lovely word.
That was the most. That was some great hopium put out by the Fed at the time.
You know, it's another one.
That was a trust the science moment from the Fed.
Right. You know, the new one is peak inflation. Not this one. 8.6. It's a new high. We're at a 40-year high in the U.S. And gold and silver went on the back foot. So because the yields went up, the dollar index went up. So metals, they pushed the button to sell the metals. We hit a support level. We're getting to technicals a little bit. 2147 was a very strong support level for the silver. Gold really didn't move much. We went down about by $15. But the Dow Jones selling off currently as we're recording this, down about 800 points, 2% down. The S&P index down. Eurozone down, Loonie down. There's just volatility all over this market. The VIX is skyrocketing. What's going on with metals? Safe haven support. Money is flowing back into precious metals, boosted the silver price up by 50 cents almost within probably an hour at a meeting with a client.
What changed?
What changed? Sentiment changed. Everyone's looking for safety now. If this inflation, it's a signal of stagflation, because if the World Bank and everyone's signaling low growth, low GDP, and you have higher inflation, that is stagflation. World Bank talked about stagflation this week as well.
The number 18778 Silver, the website guildhallwealth.com. Everything we do at Guildhall is physical. Only physical gold and silver. I actually just got back from an audit at the vault, Jerry. We had an RSP client who wanted to visit their product, see it in firsthand. Great product. They had Nadir 100-ounce silver bars.
Those
all
are great.
In packages.
Beautiful.
Each one is packaged individually. And, we gave them their inventory report. They went through all the serial numbers. Yes, it's all there. So this is what we do at Guildhall. We help people have physical precious metals in their RSP, TFSA, their registered account. Now, it is kind of interesting that gold and silver is low right now. I think that is sort of counterintuitive to what you would think would be happening. But I'd like to bring up what happened in 2008 as to why this time could be different. You're talking about stagflation. I think there's going to be a lot of talk about recessions. The central banks, whatever they're monitoring, they have to deal with. They're looking at their charts or whatever their methodology is. Whether or not they want to call it a technical recession or not, it certainly feels like we're in one. Mm-hmm. How did the metals perform during those times? Well, in 2008, when the subprime happened, which they were already into the recession, gold and silver both went down. But here's the difference. Both gold and silver went down at a time when they had already been running very strongly for quite some time. Gold started that decade off at $250, ran to something like $950 before it fell down to $650 during the subprime crisis. Mm-hmm. And then within 3 years, it was trading at all-time highs. Silver had also just reached a high of $21 after, having gone up for almost a decade and then pulled off. So we were coming off highs.
That's right.
Whereas with gold and silver right now, we've been consolidating at the lows.
Yep.
So we're on the launch pad. It is a much different setup. And so, while history can repeat, or doesn't necessarily repeat, it rhymes. And in this case, we're not at all-time highs. We're sitting in a consolidated period, and it really is a launch pad. Don't you feel that way as well?
This is such a launch pad. David Morgan writes a lot about this technical consolidation of metals, specifically in silver. The longer something, especially the silver market, again, consolidates, which is sideways trading within a dollar band of maybe $2-3. We've seen a bounce anywhere from $21.50 up to $24. So this band, we've been trading sideways for months. The longer something consolidates sideways, the higher the peak, the higher the volatility, the topside volatility. So yes, this is a huge launching pad, one of the most exciting launching pads to be on. And I don't see any other launching pads. Where other launch pads can we put our wealth on? Could we put our hard-earned wealth or wealth that was passed on from generations that worked hard, that worked the land, that worked and were entrepreneurs and industrious people who passed wealth on to us? Are we going to squander it? Are we going to roll the dice with it? No one's doing that today. Well, some people are. Malinvestments everywhere, right, Jeremy?
Well, I mean, that's the result of money printing. The central banks have printed all this money, and they've eroded the value of the dollar, and with it, I think the culture as well. I think there's a culture of, well, nothing seems to matter, and there's no consequences. There was no consequences after 2008. They go after some small level subprime person or whatever at the bank, but the banks were essentially given a get out of jail free card, and they were considered too big to fail. Ironically, I just saw a headline yesterday that in London, they're saying that the banks are no longer too big to fail. So it seems to me that the central banks are now going to have to sit back and say, okay, there are going to be winners and losers through this now, because we are going to have to pull back on the money supply. The Fed's only raised interest rates 75 basis points.
That's nothing.
And look at what we're dealing with right now.
That's like using a little water gun against an inferno. They're nibbling at it. They're not doing anything to quell. And mind you, they're going to be reversing course very soon.
Well, if we're going to mix metaphors, it's sort of like the water gun that broke the camel's back, because it's really just the smallest amount of interest rate has caused absolute chaos in the markets.
Yeah.
So, yeah, I think that they've raised the rates, the dollar went up, gold went down. These things are kind of surface level, narratives, algorithms, as you mentioned. But in the longer term, in the bigger picture, for those who might be frustrated with what they're seeing in the gold market, you got to hang in there, because you got to look at the big picture, the big narrative,
the why
of why are we, do you think the dollar is going to be saved? Do you think there's value in the dollar? What do you think the Fed's going to do? They're going to hope for lower report numbers. They're going to try to pause. They want to pause. I'm sure they want to pause. I'm sure they don't want to reverse course, but they're definitely going to end up pausing. I think so too.
Yeah. I mean, this has to happen. We've seen the taper tantrum before.
2019.
2019, very recent. And we have to
Oh, no, wait. Was it December 2018?
18, I think.
Yeah.
Yeah. So we have to realize and see the big picture as to why they're raising interest rates. They're raising interest rates because the Fed has a dual mandate of controlling inflation and helping with employment. And they're not doing either. But they're using the interest rate hikes. That's their only tool. Interest rate hikes to lower that inflation, to lower it. That's their one goal. But they're headbutting so many things. They're headbutting the homeowner, the home investor. They're headbutting Wall Street. We're headbutting Bay Street. We're headbutting everybody for the one cause. So this is the reason why. They're not going to headbutt everyone. They don't want to fight. They don't want to go against Wall Street. They will recant and reverse course. It's very simple to do. They have done it before and they'll do it again.
And if they do, and when they do, the dollar's toast. That's it. And things could unwind rapidly. And that's when you're going to want to make sure that you already have your gold and silver in your portfolio. The number 18778 silver, the website guildhallwealth.com. If you've never purchased precious metals before, try our e-store. It's guildhallpreciousmetals.com. You can pick up 10-ounce bars of silver, or maybe a tube of silver maples, an ounce of gold, maybe even a 10-gram bar of gold just to get started. Get the physical in your hand because you want that aha moment of understanding, wait a second, this isn't an investment, it's money. And as money, it's a store of wealth. Always has been, always will be. Nothing new under the sun. It's Guildhall Wealth Management. This is The Real Money Show on AM 640, and we'll be right back. Welcome back to The Real Money Show. The number 18778 silver, the website guildhallwealth.com. If you want to have physical precious metals as part of a protection strategy for your wealth, you give us a call. You go to the website. You can even hold physical gold and silver on an allocated, segregated basis, held in an armored vault outside the banking system, but within your registered retirement plan. You can do that through Guildhall. We'll show you how it's done. Everything with Guildhall is physical. So, you can pick up an ounce of gold, pick up a tube of silver maples to get started, start to understand having physical precious metals as part of your portfolio. And then you can move on from there. Maybe you can get into the storage vault facility, or you can even put it into your RSP. And again, no counterparty risk. You always retain full ownership of your physical precious metals. So that's gold ownership, not gold investment. Now, let's get to, in the second segment, we always like to throw out some stuff from Gold Telegraph. Here's one, Jerry, that came out this week. An IMF insider is now warning that inflation will stay above the Fed's 2% target for a long time, and there is a risk of inflation expectations de-anchoring. Remember when an IMF official said, a world with more than one reserve currency is a more stable world. Something to remember.
Mm-hmm. Memories.
Here's another one. The World Bank is warning that the global economy may be headed for years of weak growth and rising prices. Their response to that is, you don't say, buckle up. These are so great. And lastly, now the Federal Reserve's balance sheet is 36% of gross domestic product.
Of the entire economy.
Of the entire
economy.
economy. Of their balance sheet.
The economy is the Fed, a private Western central bank.
Yeah. There you go.
Goodness.
So this leads to the idea of central planning, right?
Yes.
This is what we're experiencing right now in our society. There's this rush to central planning. Right? You see it with the current government. Everything is trying to become top down. Everyone seems to want to tell you how to live your life. I was seeing a lot of articles this week about, this government wants more equity across, equality across the economy. I'm not sure what that means. It sounds like take from the rich to give to the poor, which is a great way to buy votes. But that doesn't necessarily do anything for the economy long term.
Not at all.
Right?
Buys the votes.
But again, it's all about this central planning. And the question becomes, when do the cracks in the system start to appear? And I think they've happened on the central banks. I mean, the central banks have gone way too far. I don't know how they have any credibility, but it is going to disappear rapidly at this point.
Yep.
Everyone can look around and see that. Yeah, okay, there's places you can put some money. There's places to invest. that's not why we're here.
Yeah.
We're here for the fact that there is inflation, that the Fed did lie, that it's going to be worse than they've put out, and that they're not coming to save the day.
No central bank is saving the day anymore. Just this past week, the European Central Bank came out and went to action on their policies, their monetary policies, and the Lagarde had mentioned that they warned of no more QE. They're going to turn off the taps and signaled a new rate hike cycle. Not as aggressive to start as the U.S., so they'll start with 25 basis points, which is nothing. Remember, the Eurozone is already negative interest rates. But then Lagarde warned that, again, this was a huge news piece, a contribution to the global rout that we're seeing right now, because they're ending QE, hiking rates in July. This was tempered somewhat by their capitulation to the mounting concern of fragmentation. Now, this quote went around. What is that? Well, we have to remember that there are a lot of European countries, Greece, Cyprus, now Italy. There is a meme or a hashtag, ITALeave, like Brexit. There is concern that Italy may want to leave the European Union. Now we have to keep our finger on the pulse on that one. Definitely see what's going on in the Eurozone. But central planning, this theme of central planning, they're losing control. They have lost control. They have no control, and it's leading back to national, just more than one currency, Jeremy. So no more of this European. We'll see if this Eurozone, the European Central Bank system, if this experiment is going to work, but it doesn't look like it's going to work at all.
Well, it's reached its limits, and now it's going to be a question of, do you go all in past the precipice, right? Are they going to just roll everything back once they've destroyed the economy? And again, it makes you wonder, why are they want to do this? The Fed could have raised interest rates 5 years ago. They could have raised a quarter point here and there. They decided not to. They've decided to do it at a time where they're never going to chase the actual inflation that's out there. It's running way too hot. CPI was over 8%. I mean, This is the most in 40 years. You're never going to chase it. The only question that I think anyone listening to the show is, how come gold and silver aren't rapidly taking off right now as we speak?
And 8.6 is the U.S. What's happening in the Eurozone, going back to them, it's 9.2%. UK is 9.1%. So these are developed, nations that are supposedly leading the world. And, they have to do something. Obviously, they have to try to raise rates. And when they signal a reversal, that's when they lose control. This is when gold and silver get let loose, because once a central planning system, our central banks lose control, lose credibility, lose trust, gold and silver on the launch pad, ready to take off until they reverse. So over the course of the summer, we may have a little lull. We may have continuous trading in the channel. We could see a little bit of a breakout with anticipations of potential pauses here and there. But this is the launch pad, and stagflation is here. All of the central banks are now warning. Now, look, government officials, central banks, all the talking heads on CNBC, they can talk about a strong economy all day until they're blue in the face. But the data says otherwise. You have low growth, super high inflation. That is stagflation. And it was the World Bank who came on the lines this week talking about stagflation. The headline was, "Worry about stagflation. A flashback to the 70s begins to grow." And the World Bank issued this warning. The world economy is again in danger. This time, it is facing high inflation, slow growth at the same time. It's a phenomenon. Stagflation. That's the world that the world has not seen since the 70s. What did gold and silver do during that time?
Well, in the beginning, they didn't do much. That's the thing. Is between 76 and 79, it's not like they did a whole lot. But then once kind of the jig was up, it really took off.
Yeah.
So this is one of these things where we've gone through transitory inflation. Now they've raised interest rates 75 basis points. They're destroying the economy as it's happening. How much further are they going to go with this charade before they have to before they have to reverse course. And that's when things are probably going to really, really get hot and get really spicy in the market. And I think that's what we're seeing right now. So as it is, for those who have the physical metal, patience is a virtue. For those who haven't been positioned in the market yet, what are you waiting for? It doesn't get to look much better. You're not going to get to open the newspaper one day, read your horoscope, and say, today's the day you better get into the gold and silver market, because you just don't know when you're going to hit an iceberg. Yeah. So you need to be prepared. You can't wait for after the house is on fire. You need to get the insurance policy beforehand, and that's what gold and silver is. It's an insurance policy against these central banks and these politicians that don't know what they're doing. Mm-hmm. That's what you're hedging.
Yeah.
Right. So you can, again, a properly diversified portfolio will say, hey, okay, I'll follow that narrative. I'll follow this narrative. But just in case they are completely incompetent, which we think they are, this is what you need to have in your portfolio. Mm-hmm. So it's pretty straightforward. Now, what you don't want is a gold and silver investment, because if you're going to have physical gold and silver as an insurance policy, you don't want an insurance policy that has counterparty risk. You want to actually make sure that you own that physical product, and that's what we do at Guildhall. So the number is 18778-SILVER, the website guildhallwealth.com. Give us a call on that. Now, speaking of that, we've been saying gold and silver are on the launch pad. Jerry, you mentioned, we mentioned at the top of the show we would discuss Rafi Farber and the COMEX inventories.
Yeah, that's a huge one. And it's kind of in line because what came out, we talked about the Fed's balance sheet represents 36% of their economy, a third. So Rafi Farber, who does a lot of work for the Arcadia Economics, puts out some fantastic videos, especially in the silver market. So we recommend tuning into that show, specifically the one titled COMEX Silver at 4-year low. So he talks about the inventories. But what he also does, he goes into the Fed's balance sheet, because that's what was released this past month. It was the May 2022 Fed H.4.1 release, whatever that is. But anyways, it goes into the balance sheets of the Fed. So yes, the Fed sheet represents 36% of the GDP, but it goes into the other assets in the Federal Reserve. And we've all heard about mortgage-backed securities coming back. Well, they pumped it up again even more. And he said in the video, which was quite alarming, if the mortgage-backed security, which is on the Fed's reserve balance sheet, and the balance sheet is the asset side of the dollar equation, with the dollar being the liability, then effectively 22% of the value of the US dollar is backed by these mortgage-backed security, which means that when the property markets, when the mortgage-backed securities begin to fall, and when they do, the US dollar will go with it. This is a very dangerous scenario. The US dollar is not the safe haven. That's why we're seeing today the safe haven is gold and silver. That's why the money is flowing out of these derivative assets and into real assets, assets that remove all the counterparty risk ahead of this show that we're about to see. And again, this is $2.7 trillion mortgage-backed securities represent out of the $12.2 trillion in assets that the Fed has on the balance sheets. So a massive 22% of all of their assets is these mortgage-backed securities, Jeremy. Quite alarming. USD, not the safe haven. It's not even the US dollar. It's the U.S. Federal Reserve note.
The emperor clearly has no clothes.
Look at it.
You need to stop trusting in the almighty dollar. Trust in yourself. And in doing that, you have to protect yourself. And one way to maintain sovereignty is to have something that has no counterparty risk. Now, Jerry, what is the status of the COMEX and the silver supply on the COMEX, the inventories?
It's draining. We're at a 4-year low. Rafi Farber talks about that, obviously. And going into the costs of extraction, we're seeing the silver miners starting to struggle because we're in the 2150 zone right now, $22. So they're not making much money. When you have inflation, their costs are going up. Silver has one way to go. It can't go below their costs. And
which I think is about 2070.
Depending on the mine. If you're just going through the mines, some are at $21, $20. They're basically scraping by. But we're seeing inventories getting lower and lower and lower. This is signaling, again, the producers that manufacture goods, whether it be electronics manufacturers, weapons manufacturers, they're trying to forecast 6 months out. Well, what do the prices look like for your lithium, your zinc? They're going to be double in price, so they're buying it now. They're taking delivery now. They're putting pressure on the COMEX, the LME. Last week or last month, the copper inventories were down 4,000 tons. Today, this week, down 20,000 tons.
Let's stay on this topic. We'll talk more about the inventories and what it can mean for the precious metals prices going forward. The number 18778 silver, the website guildhallwealth.com. Get some physical precious metals in your portfolio. Fully allocated, fully segregated, registered accounts. Give us a call. We'll show you how it works. But protect yourself. Have your own sovereignty, and the best way to do that is to have an asset that has no counterparty risk. It's The Real Money Show on AM 640. We'll be right back. Welcome back to The Real Money Show, the number 18778 silver, the website guildhallwealth.com. Protect your sovereignty, protect your wealth, physical gold, physical silver, no counterparty risk. Now, Jerry, before the break, we were just talking about the COMEX inventories, and you were saying that essentially a lot of industry is going out and acquiring materials now because they feel that either the prices are going to be higher in the future, short future, or short term, or that prices are going to be way, way up in the short term. So how is that going to reflect in the price of the metals going forward? What is that going to mean when investors decide they want to get involved in the physical gold and silver if the COMEX right now is already at all-time lows or 4-year lows?
Well, this is going to be putting some significant pressure on deliveries, which ultimately lead to ultra-high premiums. This past week, we saw premiums get slack a little bit because of the lull in the market, but this doesn't stop the producers from requesting deliveries. We know in the futures markets, which are just derivatives markets, it does guarantee delivery at the end of the contract. And in times of an inflationary environment, which is where we're at, they're no longer rolling over the contract. They're requesting delivery because they're trying to forecast their prices going forward. And they'll likely just want to lock in their prices. Let me exercise this contract and want to take delivery. Does the COMEX have physical deliverables ready to go? No.
Well, they're not necessarily a delivery mechanism either. They're meant to be there for price discovery mechanism, but it's not necessarily supposed to be the place where you go to get your supply. It's not a farmer's market. It's the commodities exchange. It's there for them to trade gold and silver, but not necessarily for everyone to just be going there to get your inventory.
And with the inventories at a low, coming at a 4-year low, they're losing the supply that they do have, and which is that Achilles heel for the futures instruments.
So, let me ask you this. If we were to see the silver squeeze today that we saw with the, I call them meme stocks or whatever, with the meme stocks, with the GameStop and AMC, we saw the silver squeeze come in February of 2021. If that were to happen today, do you think they'd be able to tamp down, in air quotes, the price? Do you think they'd be able to save the COMEX from a default if it were to happen today instead of a year ago?
No, no, they can't, because we're dealing in a physical asset that's moving around. That's a physical asset that's in demand for suppliers. And a share, on the other hand, can be tempered. You can, cause a circuit to break in that type of market. But when you have a market that's dealing in the physical outsourcing of physical gold and silver and lithium and zinc to the world, you can't do that because you need the physical supply somewhere. And it's exposing the derivatives of 100 to 1 for gold. For every 1 ounce of gold, there's 100 of these derivatives. It's a shell game. The 400 to 1 in silver. So when we're talking about
You're talking about paper to physical gold.
Paper to physical. This is going to be revealed, and this very instrument that has been used just to answer some of people's questions about, why isn't the silver market going up? Well, they're using instruments to temper the price because the price is a barometer. The gold and silver prices is a barometer of economic health. And if you have gold and silver taking off, something's wrong. It's going to cause, Joe to pull out his money out of the banks and the stock market and buy gold.
Yeah, it's not a massive conspiracy theory. It's more like a matter of course for central bankers. The enemy for them is gold. If your purpose of being is to print money and use a paper system, which is why central banks around the world continue to acquire physical gold, because they're hedging against the ineptitude of these central banks that are causing all of this strife around the world with these economies. Mm-hmm. Speaking of central banks, Jerry, let's skip over to Bank of Canada.
Oh, coming home.
We're going to come home.
All right. What's going on?
This was by the Canadian press. The Bank of Canada says household debt and home prices are key risks for the financial system. So the Bank of Canada said vulnerabilities from high household debt and elevated housing prices have increased and posed risks to the Canadian financial system. Now here's a question. Isn't it the Bank of Canada's low interest rate policy that created this risk? For almost a decade now of keeping interest rates super low that would fuel a bubble in, I don't know, let's say the real estate market, where you could borrow countless thousands of dollars over a time.
Over and over again.
And push the market higher?
Yep. They're at fault. This is the fruit of what they've planted. They've planted low interest rate policies, stimulus. What can go wrong with endless amount of stimulus? The juice is going to get cut, and the juice is getting cut on the assets that are in the pensions, the assets that are in these REITs. Investors need to worry. Now, if you're a financial planner, I had a call with a financial planner this week, and topic was stagflation, and the client had serious questions about stagflation and wanted to know why they weren't receiving any information on how to deal with stagflation in the market. The planners and the central planners, they know one thing, and they will keep the game going. Like the mainstream, they will say the economy's strong, buy the dip. But as Crescat Capital said, buy the dip only if it's commodities. If it's a commodity, buy it. Don't buy these equities because the dip will get dipping.
We'll continue on. Here's a quote. In an environment of tightening financial conditions, high global inflation, and increased geopolitical tensions, financial system vulnerabilities have become more complex and risks have become more elevated, the bank said in a report. Assessing the vulnerabilities from high household debt has also become more complex over the past 2 years as household finances have generally improved, even as debt levels have increased. But households on average have seen their net worth increase. That's what they're saying. And then on the other end, they're saying the bank, however, is saying that that there's an increasing share of households that have stretched themselves financially. So the Bank of Canada is talking out of both sides of its mouth. It's saying, a lot of people managed to save a lot of money through the crisis. But, by the way, there's a growing number of households that have stretched themselves a lot financially, and they're becoming a risk to the system. At the same time, it's all the same thing. The central bank lowered interest rates, allowed this bubble to balloon. They did nothing to stop it. They did nothing to level with the public. And so the public they blindly, naively trusted the government. Mm-hmm. And they need to figure out how they're going to trust themselves and how they're going to protect themselves.
Right.
And that's why we're talking about having some physical gold and silver in your portfolio.
Yes.
The number is 1-877-8-SILVER. The website, guildhallwealth.com. This is The Real Money Show on AM 640. We're just talking about the Bank of Canada. And you know what, Jerry? It seems to me that the Bank of Canada is hyper-focused on the real estate market. And sometimes you kind of have to look back and say, well, what are they not focused on? They're focused on the real estate market, saying that, that it created strong growth in housing prices throughout the pandemic. And that was kind of, that was a short-term thing. Now it's becoming a liability. This was all of their own making. But what are they not talking about? They're not talking about manufacturing. They're not talking about tourism. They're not talking about commodities. They're not talking about any other industries in Canada to depend on. And so we have to then assume that for some reason, they have tied the economic engine of this country to real estate and created a bubble themselves. And now, as Colin Powell once said, you broke it, you own it. The question is will they own it?
No, of course not. The fact of the matter is, when you remove the entrepreneur and the industrious person and the way that we used to value wealth, which was by weights and measures with assets, they have translated the perception of what wealth is by the value now of your house. But the people can't just go out and buy a house for 500,000, 600, $1.5 million. They got to go on credit. And the credit system is the noose of the central planner. It is the noose, and it's the way that they can control people. And by getting you into a credit-based system, that's the goal of central planning, is to control the masses through the credit system.
Not just through the credit system, Jerry, but also through certain narratives. And there's something, this article just sneaks in, this article by the Canadian Press just sneaks in right at the end, saying the Bank of Canada says that Russia's invasion of Ukraine has also further complicated the transition to a low-carbon economy and increased the risk of repricing of assets exposed to climate change. How woke is our central bank? That is the most woke comment for a country that has made its entire existence on digging holes.
That's right.
Okay.
Yep.
All of a sudden, we're supposed to just, there's going to be some pain. We're going to transition to these things that are completely not biodegradable. All of these windmills and solar power, and you're never going to fly a plane again, which means you're never going to be able to build planes again, which means all of that intellectual property just disappears. It's how quickly can we become Cuba? Oh, there's some interesting kind of connections there maybe between Cuba and what we're seeing in Canada right now.
Good one.
Let's talk about gold and silver to finish this in terms of what's going on. So what we've talked about today is that gold and silver right now, specifically silver, is at the almost at the price of production, cost of production. We are at lows in the market. We are not at all-time highs. We are on the launch pad for this market. At the same time, we're seeing inventories on the commodities exchanges rapidly disappearing. I would also note that the short positions in the market are also unwinding, which is getting the big banks in a position for this market to rise much, much higher, right? They're not going to be on the wrong side of the trade. So we've got diminishing supply. We've got a market that's already at the cost of production. And I think we slightly mentioned that these mining companies would probably slow down their production too. If they can't make money on it, why move forward with the production? It's better to just halt things and wait till, and you don't just flip a switch and it starts up again.
No.
Right? So you could be setting up kind of like every other supply chain issue where it becomes difficult to get the product down the road. And then to add on to that, if it couldn't get better, if you were looking to buy precious metals for the first time, the premiums have just started to come down. Now that's because the prices were coming down, and eventually the wholesalers can buy a little bit of product at these lower prices. And so the premiums have come down slightly as well. So what an amazing opportunity.
Yeah, that premium, that lowering premium that we saw this week, and it's probably be transitory. I think that premium lowering is going to be very temporary. So this is a very good opportunity to take advantage of prices getting cheaper for you. These are assets that you want to be able to convert your paper fiat currencies that are literally being destroyed, that are being just pummeled by inflation, by these central bank failures. And we're on the precipice. Ray Dalio, he famously once said, if you don't own gold, you know neither history or economics. What we're seeing right now is this move, the canary in the coal mine. We're watching that. Everything has left. Everything has left the train station. You have nickel, zinc, copper. Everything's moving up. All the resources are moving up. Oil hitting 150 very soon. Gas prices here will be $3 by fall. The canary in the coal mine's out. Gold and silver are on that launch pad ready to go, because when history shows, when these markets start to move up, these base metals and these smaller resource metals start to move up, gold and silver always last. They always have to play catch up, and the ratios will start to make sense once again.
It's better to position even a little bit than, because there's nothing wrong with waiting for the price to rise. There's nothing wrong with waiting for some momentum to say, okay, it's off the mat, it's starting to move. Great, now I'm ready to get in. The problem is going to be that 3 times in the last 2 years, we've seen a situation where the retail market got completely zapped.
Cut out.
The shelves were completely cleaned out. And so you want to create some relationships. You want to have some skin in the game. You want to have a little bit in the market, start understanding that market so that when things do start to take off, you're in a position where maybe you can get more. Our greatest fear is that you won't be able to get more, that the price is going to be taking off so fast and just rocketing higher and higher, and the ability for people to actually get into the market disappears. So it's better to be a month early than a day late. You need that insurance before the house gets set on fire. And guess what? This is all tinder.
Exactly.
Everything we've talked about today regarding the economy is all just tinder that's smoking. So we need to protect ourselves. Physical, gold, and silver. Jerry, I think that's it. I think we did it. That's the end of the show.